if you don't hear it from us, you're not going to just stumble across it. You need to be slapped out of your stupor where you've never questioned anything and start questioning. Questioning is a better posture than just blindly accepting. I want us to know the enemy. I want us to know what we're dealing with. I want us to recognize that the rules of the game are not going to change materially. I don't believe in our lifetime. Banking is. It's going to exist and you're going to interact with it in some capacity. We could still be right about how flawed this system is and then lose because we don't understand the game. And the game goes on with or without us. All right, hey, what's up? Welcome back to Remnant Finance. This one's going to be a little bit different. I'm going to put this one in the hopper for when we need it. This is a solo episode today that I'm going to be recording because we want the show to go on. And Brian is currently, I believe, in the Bahamas right now with his family. Took a vacation there. It's one of the great things about working towards this idea of, we talk about, we don't believe in retirement in a conventional sense. Brian and I don't plan to retire in that sense, but we want to set up a system where, in line with what we've talked about with Joe Withrow, bringing in passive income that can allow you to coast for a little bit when you want to. You could do mini retirements. We want to keep doing this business as long as we possibly can, as long as people are listening and people want to fund their banking system and learn about economics, learn about IBC, learn about whole life insurance, et cetera. We want to keep doing this job forever. I don't ever plan to stop doing this, but we want to have the control that comes with either being self-employed, having passive income. If you're in the quote retirement years and you're able to just take that time off, it's pretty cool. And coming from a W-2 world where I am used to applying to take leave, it might be denied. Anytime I want to spend time with family, I have to either request, well, back when I was a pilot, we request off the flight schedule. You're kind of micromanaged and it's not too bad for, being an officer, you get a lot of opportunities to take leave, but at the end of the day, I'm still asking someone else to take leave. It's the new mindset shift for me as far as being able to just block off my calendar. In a couple of days, we have a free Hyatt night that we have to use by the end of March. And so I blocked off a couple of days on the calendar, booked the night. We're going to go just take our daughters, do the pool. We're staying here in San Diego, just going up to Mission Bay and a little staycation kind of thing. But it's nice to be able to just do that when we want to. And I hope for all of our listeners, everyone that is implementing IBC, that you're doing it towards the goal, not only of, most importantly, obviously supporting your family and making sure that you leave a legacy to your children's children. You leave that inheritance. You ensure the protection side that if you walk off this earth early, your income and your provision does not walk off with you. Of course, that's the main primary check in the box: protect, save, grow. That's the protect side. But we want you to get to the point where when you're doing this, you can have the flexibility to just, hey, I'm going to take 2 weeks off and go do a cruise or whatever. And the cruise might be ending right now. And I think Brian is about to move out of a house. He just purchased a new house. And so having that flexibility is really cool, kind of good proof of concept of what we're trying to work for here. And of course, we're talking a pretty small scale, a week-long cruise or just taking a couple of days and going to a hotel here in town. That's not moving the needle in the big picture of things, but it's the freedom that we want to give our families through what we're doing. And it's what we want for you as you work towards your financial goals, whatever they may be. But today it's nighttime here in San Diego. Family's gone to bed. And so like everyone, I typically just read about macroeconomics. We all do that. We all wind down after a long day with a book like this. This is called the Encyclopedia of Central Banking. It's a fascinating read, honestly, that I can't put down. And I know that sounds preposterous. And I kind of view this as know your enemy, which is why I titled this episode, Know Your Enemy. I want us to understand what we're dealing with. I want us to have a good grasp on the rules of the game because they're not laid out to us clearly. Now, we say, and we try to break down in a way that we can all understand what is happening in the banking system, what these macroeconomic forces are that are working against us, the eroding factors that are always coming out of our wealth, et cetera. I think we do. Brian and I, as well as the IBC community in general, does a good job identifying the problem. More importantly, posing a valid, sustainable solution via the infinite banking concept. So that part, I feel like we are saying what needs to be said because, like I've said before, like Brian said before, anybody else you listen to in the IBC space, if you don't hear it from us, you're not going to just stumble across it. However, obviously high school and college education, your economics classes, but they're just garbage. It's junk economics. I was in the fortunate position, as I've talked about before, to get to study under a few professional, essentially celebrity economists doing my master's program. And I was in the initial phases at that point of just waking up to all of this. I am where a lot of people are when they discover infinite banking, and a lot of people that had a lot of things open up to them over the last couple of years. What we talk about over and over, you see through how we've been misled, right? So for me, I was reading The Creature from Jekyll Island. I was learning about fractional reserve banking. I was learning about what central banking is, about the Federal Reserve, et cetera. And when you cannot read, though, you cannot read The Creature from Jekyll Island, which you should all read. If you haven't, just pause this, go buy it, look at our reading list on the website. It's essential reading. You have to read that to understand what we're up against and how we got to where we are today. And I wish I could go back to those classes now, to those professors now, and ask them questions with my current level of knowledge. Because at the time, I felt like I was having this whole world open to me. I'm learning all these really fascinating and terrifying and infuriating things about how our economy works, but I couldn't speak the language. I could regurgitate what I had read a little bit, and this was before I learned anything about infinite banking. Before I knew, if you had asked me at the time, I would have told you I would never in a million years consider owning a whole life policy because I knew it was a bad investment. I knew it was a bad place to put money. I would have told you buy term and invest the difference, but the truth is I didn't even have term. And of course, nobody actually invests the difference because nobody prices out what those two values are and takes that amount and actually allocates it into an investment they understand. We talk at length about the problem with the conventional financial planning model. And the more I learn about both the underlying motivations and the underlying infrastructure of financial institutions, as well as kind of the behind the scenes of central banking a little bit, the more I realize that I feel more convicted and more validated in our critique of the financial planning sector. At the same time, it's necessary to have that skepticism when approaching this. No one comes to IBC totally on board with everything. Like you come to IBC the way that a lot of us came around to for the first time ever questioning what we were injecting into our bodies, right? Via COVID, it's like you need some kind of switch to flip. You need to be slapped out of your stupor where you've never questioned anything and start questioning. Questioning is a better posture than just blindly accepting, because blindly accepting would get you the food pyramid. It'd get you now 72 shots by the time you're 18 per the CDC vaccine schedule, right? It still includes 3 COVID shots starting at 6 months. That's today, March 2025. 3 COVID shots are in the childhood vaccine schedule per the CDC. And so you have to have this questioning attitude. But you also need to understand the other side of the coin as far as central banking goes, as far as our monetary system goes, because once you see that, there's a tendency to just jump so far to the other side that you're like, F it, let's just barter with silver coins, right? Let's burn this whole thing down. And I have felt that way because you get so frustrated. It's kind of, I guess, back to the medical side, it's like the analogy of you see that you've been misled. You see that, pediatricians are paid based on their shot uptake or intake, outtake, how many shots they give, right? You see that, and then all of a sudden you swear off everything to the point where, you have a major like first aid medical emergency and you're refusing any kind of treatment. Like that's not wise either. That's not good stewardship. Like there's value in our Western medical system in certain situations, and I believe not in, childbirth, for instance, although, unless there's actual emergency, we treat childbirth like it is an emergency itself, like it's an illness, that this dangerous, rapids that you have to navigate, when in reality, it's a natural function. And it's nice to have these guardrails in place, but we should do this ourselves, whether that's the medical side. whether that's the financial side. But when I was in grad school, I had some classmates that worked for the Boston Fed, and I remember talking to them as I'm like 101 level learning about. I'm halfway through my reading of Creature from Jekyll Island. I now understand what he calls the Mandrake method, where money is created essentially out of thin air, which is what we're going to talk about today. But I remember talking to them and asking these questions, and I'm like, yeah, but did you know fractional reserve banking? Like, I deposit $1,000, and then from that, there's $10,000 that exist now, and prices, inflation, everything. And I'm like, did you know that that's what they do? Like, they don't actually have the money. He's like, yeah, yeah, that is central bank. That is the relationship between the Treasury and the Fed and Congress, and they look kind of confused when you're challenging this, because like, yeah, of course, that's how it works. Like, that is the system. Yeah, it's a fractional reserve system. We need it, and that's what we have. And yeah, and they weren't bad people. They're not like kind of the caricature we think of when we think of like the Davos elite or whatever, trying to enslave you and eat and have you eat bugs, or it's like, it's just dudes. It's or girls. Like, it's just people that you would go get a beer with, and I would ask them over a beer these questions, and they're like, yeah, that is what I do at the Fed. I don't understand the problem. Like, what do you want? Do you want a barter system? Do you want gold? And what, you like having the world reserve currency, right? I mean, that's all plays into it. And they knew a lot more than I did. I feel like now I could have a much more nuanced and in-depth challenge to it, but that is from easily over 1,000 hours of learning and reading by now. And I think that what I observe, and again, I'm not an economist by any means, other than having a very passionate interest at a personal level, the way that people are really into guns or really into cars, whatever, like, people have their thing that they all the macronutrients and all that stuff about working out at the gym or whatever. For me, that is reading macroeconomics. Like, my family's in bed right now. At the end of the day, get the girls down, my wife goes to bed, and that is when try, if I can, depending on what I've got going on. If I don't have any work that I need to work to do, I read economics and I read about life insurance, and I'm really very interested in this. But of course, not that we have any professional economists listening to this, but there are probably people that will maybe listen to this. I hope so, because I'd love to talk more, that know more than me. And maybe there's some flaws in what I'm saying in my analysis. Again, it's self-taught, but I will caveat that with saying, like I said in my bio episode when I talked about my experience there, I got to ask, Larry Summers and Janet Yellen and Jason Furman and Robert Lawrence and people that are in, the White House, economic council, et cetera, former, until very recently, Treasury secretaries, chairman of the Federal Reserve, for instance. In Yellen's case, she was both, right? So I am not a professional economist, and they are, but at the same time, like, they're why we're in this mess, because their ideology, their approach to macroeconomics is this, right? And to them, there's not another option. I think that, again, we present a very viable option, but with infinite banking. But my thing, when it comes to how we manage our finances, is I am not of the mindset that, like, I'm not an economic prepper to the degree of, I want raw timberland and a safe full of gold and food storage and solar freezers or whatever. Like, I do want that kind of stuff. I do want those kind of things. When we get a homestead and we move to New Hampshire and get that set up, like, I want to have some that kind of thing. Like, I want some self sustainability, some self sufficiency, etc. For those blips or even extended periods where things aren't available. But I don't buy the economic YouTube fear porn of, you know the dollar's going to crash and go to nothing, and everything you have is going to be worthless unless it's a hard asset. I like a middle ground, and I like using this as a hedge. My position is, I use IBC to optimize the fiat system that I am forced to interact with, that we're all forced to interact with. And if I ask myself, do I think in my lifetime that I will be compensated in anything other than US dollars? And I think the answer is no. And I ask myself, in my lifetime, do I think that the things I would like to buy, whether that's a home, a vehicle, dinner out with friends, taking the family to on a cruise like Brian's doing right now, or buying those hard assets, buying those, quote, prepper things. I ask myself, do I think in my lifetime there's a chance that those will be denominated in anything other than US dollars? And I personally don't. Also, so my assumptions going into this, I'm always going to be paid in dollars and I'm going to have to purchase things in dollars. I think there's a very high likelihood that those two things hold true for my whole life. Also, I don't get to set macroeconomic policy. I don't get to set monetary or fiscal policy, which is an important distinction that we need to make. And we'll get to that. But I don't see a way to skirt around the issue of central banking without going through it. You have it exists. It is banking is, as I believe James Nethery says that, one of the OGs of infinite banking. Banking is. It is just it's going to exist, and you're going to interact with it in some capacity. So what I sometimes see is when people get this understanding, and like I mentioned before, it's just this kind of burn it down approach. This whole thing is evil. End the Fed. We need to get rid of this. And I get that, but it's not going anywhere. And so let's study the flaws of the system and understand them, because 99% of economists, and more than that, 99.999% of public actors, which is what the economists would call us, like people that interact, engage in the market, in the in commerce, operate off of these certain assumptions. So we could still be right about how flawed this system is and then lose because we don't understand the game. And the game goes on with or without us. So rather than just being able to point out a few surface level issues, let's explain some of the mechanisms in detail. And if nothing else, I'm not trying to sway you on anything, but I want to increase your level of economic literacy when it comes to how this system works. And so I'm going to go through a couple topics here, and this might be probably several episodes, maybe every once in a while when we need to kind of fill up our buffer of episodes to work on. I might just cover a few more topics. I want to talk about what is money, and that's I'm going to do it from a very brief perspective. I mean, I probably read about 10 books on the topic. There's hundreds of them, and there's not a consensus. We'll cover a little bit of that. What is fiat? We'll talk about metalism versus chartalism. Talk about central banking, their function. Talk about fractional reserves, state money versus bank money, and two really interesting concepts that I think are worth discussing, and probably definitely won't get to them on this recording, but is Trippin's dilemma and the yield curve. These are things we hear about a lot, but I think it helps to understand these. So I'm going to speak their language to the best of my ability. So I'm going to say things with their underlying assumptions. And so it's not necessarily that I'm defending or putting forth these opinions. I'm going to try to make it clear what's my opinion and what is, what they say. And so the books I'm working off of, particularly, we're talking about the history of money. One of my favorite books is called "And Forgive Them Their Debts" by Michael Hudson. Michael Hudson's an economist. He's my favorite economist, I would say, because of the way that he breaks down what we think of as, we have this idea that capitalism is what we have and socialism is this bad thing. And socialism itself is bad. But when you understand the role of centrally planned economy, like that's what we have. You don't have to call it socialism, but it's much closer to that than capitalism. Capital, if we understand what capital is economic potential energy. It's an asset that has ability to convert to the attainment of things we want. That's not what we have. That's not what Wall Street is. Wall Street is not a capitalist institution. It's protectionism. It's cartelism. The financialization of the economy. The role of a dollar is just to make more dollars. No underlying value. That he breaks down very well what financialization is, and it's like this. The idea that there's this what we would call the monetary base, how much money exists. For instance, if you look up, we can all quote the statistic in the last 5 years. 70 to 80, depending on what you look at, percent of dollars ever created were created in the last 5 years since COVID stimulus, right? But that's just the tip of the iceberg, because the derivatives market dwarfs that. The bond market is kind of the largest player in the global economy, in the US economy. The stock market's a sliver of that, but that is how we measure the economy. That's why the stock market can keep soaring as everything else seems to be spiraling out of control. What is money is a long tail, and there's a few different schools of thought. But before I get into that, just to go back to a little bit more introduction, like I said, we're going to assume their underlying assumptions, and we're going to remember that every nation does this, and so it is something we need to understand. We cannot get away from this, and no nation has. Fiat money is something I want to talk about specifically after we talk about a little bit of what is money, and I'm gonna do a 0.25% skim overview in order to get there. But when we think back to when we had a gold standard in this country, there's a really good case in the book. I can see it over my shoulder there, The Lost Science of Money. Steven Zerlinga makes the case that even gold is fiat money because, and this is going to be the meat of what we talk about today, is state money versus bank money. It's what is the sovereign declare the unit of account for the payment of taxes which they are allowed to levy, right? We know the tax situation is spiraled out of control in this country. We know it's miles off course from what it was intended to be. We know that the personal income tax is likely unconstitutional. Maybe it's going to go away, but at the end of the day, in a perfect world, there's still taxes. It should be on commerce from, like corporations should pay taxes. There's taxes between states, there's taxes between municipalities, there's taxes with other nations. Like the government is funded by taxes. Even in the perfect world, it's not like we're just getting rid of taxes. And so there has to be a sovereign, there has to be a governing authority to declare how those taxes are levied, what the unit of account that they're settled in, and who actually creates that. And so before I get too far down that road, because that is one of the topics I want to talk about, I want to bring it back to a problem that is continuously recurring with economic modeling. And this is why everything I talk about today is conceptual, because once you start getting into models, you're really just kind of throwing things at the wall, and the human element can derail all of that and make that model mean nothing. And that's why I think Mises and the Austrian School of Economics is, from everything I've read, the closest to understanding and implementing the idea that what you need to observe is what actually happens. These models, it's kind of like a life insurance illustration. A second hit print, it's projecting into the future with a certainty that you can't possibly have. And so we understand when we use current dividend scales, for instance, in the IBC world, to project future dividends, that we know that that's not accurate. We hope it's close to that. Statistically, it should be within a standard deviation historically with the companies we use, but we know that it's not going to be exactly that. That's a problem with modeling. And that's something that comes up. It's called Knightian uncertainty. Frank Knight was an economist, and he coined that term. And I think it pretty well shatters the idea that economic models, as you learn in your macroeconomics class, microeconomics, are fairly maybe not useless, but certainly not anything to hang your hat on or to make big decisions by. So the Knightian uncertainty is a situation where future outcomes are fundamentally unpredictable and unquantifiable, unlike risks, which can be measured and managed through probabilities. And so that, I think that's an Austrian perspective on it. So let's talk about a little bit more about what is money. And I'm only going to brush on metalism versus chartalism. There's the idea that you hear over and over about the origin of money, and it's called the barter tale or the barter story. And it's this idea that people used to just trade, but as trading became more advanced, how do you measure a cow versus an ear of corn? And so money was created by the market as a means to settle these transactions. It's the dominant view in orthodox monetary theory. Money was invented to reduce transaction costs in order to determine a market clearing relative price. So we have these goods that need to be exchanged. How do we clear this market? We need to come up with something. It always gets to, well, it was seashells, and it was this, and it was this, and eventually metallism, gold or silver, coins, bars, ingots, whatever, came to represent a certain amount of value across the scale, so that you could clear markets that way. And you'll hear it over and over, but having read pretty extensively on this topic through Michael Hudson, who goes all the way back to Assyria, Babylonian economy, and then the law science of money, which does the same thing, focusing more on the Greeks and the Romans. That, from what I can tell, that's a theory. It intuitively makes sense. Like you could explain that, and everyone it kind of clicks. But I don't know that there's much evidence for that as the origin of money. Michael Hudson would argue that the back in agrarian, Assyrian Empire, the temple is levying grain debt, and so it's the fact that the sovereign, the temple in that case, declares what the unit of account is, and that is what becomes money. And so that is more the chartalist approach. So chartalism is the theory that money is a creation of the state; it's not a commodity. Chartalism emphasizes the role of government in defining and controlling the value of money. It suggests that money's value stems from the government's acceptance of it for taxes and other payments. That gets into what we'll talk about soon with state money versus bank money. That is about as deep as I don't want to go too much deeper with that because, whether it's someone coming up with a theory that sounds plausible, like the barter tale, the barter theory, that sounds plausible to me. And that could be the case. We don't know for sure. Or on the other side, on the chartalist side, going back into ancient history, I mean, you're looking at old tablets, hieroglyphics and that kind of stuff. Like it seems to have a little bit more evidence to it. But again, we don't know, and we don't really need to know because at the end of the day, we live in 2025 with the system we have. But it's good to kind of have a little background on that. And this is a point that Keynes made in talking about fiat money. He said the rupee, and talking about India, was a means of payment, not because it was silver, but because government fiat declared it so. If this is the case for a silver coin, then most or all money may be, at least in part, fiat money because of government decree. So even when we have a gold standard, if gold and the dollars that were generated off gold, like the amount of dollars equal to a unit of gold, that is still, if that is how you pay taxes is with dollars, which and we'll say directly in dollars, but indirectly in gold, then by fiat, which is government decree, gold is the money. If the government wasn't accepting dollars, directly and gold indirectly for the settlement of taxes to clear that market, then like gold still has value, of course. But if then you're still going back to like, I guess a barter and exchange at that point with other people that might want to take something for silver. But we're talking about a broad economy here. And so I think that the idea that fiat money is inherently wrong and gold money is inherently good, it's kind of missing. Like fiat is described as the money, but fiat is actually the decree. It's what the government says is acceptable payment of taxes. So Keynes talks about, he says, properly managed paper money will be accepted in general use because it's the medium in which taxes are paid. It's state money par excellence. State and bank money are things we're going to cover next. Bank money, in turn, consists of deposits of state money, with the caveat that banks can create state money by making loans in accordance with the rules of a state-regulated banking system. For a currency to be accepted, it must be the case that it has backing and regulation. Backing means, at a minimum, that a sovereign entity, one with what Adam Smith called police powers, will accept it in the payment of taxes, fees, fines, and so on. And so that better describes where we are today, whether that's the true history of money, whether it's metalism or chartalism. That describes where we are. And so we, again, bringing it all back to what I initially said, is we have to understand and deal with this. So fiat money, whether it's quote evil or not, whether it's, an abomination, like the way people talk about fiat money, it doesn't matter. Like kind of honestly, like what you think about fiat money to a degree doesn't really matter because that's what we have. And so when we do IBC, when we use contract law as our savings vehicle and we rely on our contractual right to leverage, et cetera, we are optimizing in the game that we have to play. So a few more things from Keynes, who, though I don't think that we should have pinned our economic future on his theories, they were pinned on his theories. That is how they all operate. They're all post-Keynesians or post-Keynesian economists. And so a little bit more about how he views what money is. He says, by virtue of its power to impose a tax liability on its subjects, the state has the prerogative to define money in two ways. The state determines the unit to wit the money of account in which its debts are measured. And two, the state chooses the medium in which taxes are due. That is the means of payment. So they set what is due and they set how it's due. And that's where we are. That's where we're going to remain, no matter what economic developments come from this administration, which seems pretty hell-bent on disrupting in a good way, at least economically speaking. We're still going to be paying taxes. Like, there's just no way around that. The quote or caveat, the way around that would be, going the Social Security route, changing the beneficiary to yourself. That gets into a whole nother rabbit hole that I'm not going to go down right now. And I'm not smart enough on it. I know that there are people that do it and don't pay taxes. I couldn't walk myself through that, so I'm not going to even try here. So I'm going to go with the assumption that we are going to be paying taxes to the state, that the state gets to determine the unit, the money of account where those debts are settled, and the medium in which taxes are due, the form of payment. So Keene says, thus its tangible form, it being money, is of minor interest because the value of money does not come from its content, but depends on its usefulness in settling tax or other liabilities to the state. So clearly, when people are using and transacting in dollars, because it's easier than using and transacting in gold bars, you could say that dollars are worth more to people than the gold, because if it wasn't, they would go and get the gold. Now, of course, we know when France tried to take its gold back in the 70s and eventually led to the closing of the gold window, there is like a mirage element to this game that if they call your bluff essentially and you don't have the gold, then this whole thing falls apart. But presumably in a functioning like gold standard economy where we actually have $20 is an ounce of gold, in that, if that's working correctly, if everything's above board with that gold standard as we had it, there is still a fiat that the dollar is the means of account for settling tax debt. And people would rather have the dollars because it's a lot easier to transact, right? And so if you have the choice between having an ounce of gold or $20, and $20 are actually backed by gold, well, the fact that people weren't regularly transacting in gold coins or gold bars to the degree that they were transacting in paper bills means that the bills you could say were more valuable. Of course, today that sounds crazy because we've lost that peg, right? There's no value to an individual dollar anymore. But Keynes would say that it doesn't really matter because it doesn't matter what you would rather have, or it doesn't matter the content of what the unit of account is, because the state determines it and the state says how much it's worth. Not necessarily the state says how much it's worth, but the state says how much you need to pay. And therefore, whatever form it takes, that's what it is. So after having named the unit of account and imposing a tax liability in that unit, the state issues the money needed for its own expenses, thus starting the use of that means of payment within the economic system. This is what he calls the monetary circuit. Economic agents, i.e., the people, have to sell products to the state, either directly to the state for what the state needs, or indirectly in order to pay taxes, selling amongst each other, conducting commerce in order to acquire money for themselves, but also needing to earn money to pay taxes. So the economic agents have to sell products to the state in order to receive the money needed for the payment of taxes. So this means that the money itself is desirable. It allows economic agents to free themselves from a tax debt. The money refluxes to its initial issuer, i.e. the government, closing the circuit. In other words, the value of money seems determined by what the population has to produce in order to obtain it from the government. This is called the monetary theory of production. The value of money is, through the payment of taxes, the mirror image of the value of goods, which have to be sold directly or indirectly to the state. Now, let's jump here to state money versus bank money, which together equals broad money. Now, there's different names for these. You'll hear legal money, narrow money, the monetary base. Those are all monikers for state money. And if you look in the Encyclopedia of Central Banking right here, I was on a wait list for like 2 years to get this, and it really is fascinating. But it's a page or two article on a bunch of different topics, A to Z. You can find sections on these different types of money. And so state money is again the unit in which tax debts are denominated and the medium in which these debts are due. It's accepted by the state and the discharge of liabilities to the state. It is the top of the debt hierarchy, which is a big concept when you're talking about central banking, because each level of this hierarchy, starting with households and then firms and then banks and then the state, at each tier, they have different debt obligations to amongst each other and to the other tiers. But at the top of it is the state. The state money represents the unit in which all monies of the hierarchy are denominated and the only one in which taxes are due. So that's state money, and bank money is a leveraging of that state money. You can think of the state money as outside money injected into the system by public expenditure. The form of that money is stored on the liability side of a bank's balance sheets, i.e., a depositor earns money, deposits in the bank, and now they have a claim on that money, and therefore it's a liability to the bank. So the ownership of bank deposits grants its holder, i.e., I deposit money into the bank, I'm the holder, I have the right to transfer funds to another account, withdraw cash, or make a payment. All money aggregates held by the public, less bills and coins, are stored in bank deposits on commercial banks' ledgers. So the total supply of money, now again, not talking about derivatives, we're just talking about the base monetary supply. You have coins and bills that are out circulating in the public. Everything else is resting on commercial banks' ledgers. So in the charterless view, if state money is exogenously created by the state in the form of central bank and treasury liabilities, bank money is then a multiple of state money recorded on the liability side of their balance sheets. This is how we bridge into what fractional reserve banking is and the relationship between Congress, the Treasury, and the Fed. And then that, if we assume that as one entity, we'll call that the state. Commercial banks would be like your Chase Bank and your Wells Fargo. They create bank money using a reserve of state money. And state money is not the same thing that we're talking about. When we're talking about the Fed's discount window, banks are trading with other banks at the discount window. They're not dealing in the kind of dollars that we are talking about here. When we're referring to money, we personally are referring to bank money because that's what we actually see and interact with, even though technically it says Federal Reserve note. But that gets into the relationship between these things. And this is a very important, I'm going to go into the relationship between Congress, Treasury, and the Fed at a basic level, because everyone shits on the Fed, right? Everyone who knows IBC knows the Fed, the creature from Jekyll Island, was created in 1913. They are the root of all of this. But I don't think that's quite accurate. Now, I don't like central banking. I don't want to have a central bank in the country. Again, not my call. It's not going anywhere. Every developed nation on earth has one, except for like 6. And if we listed the 6 or 8 or whatever that didn't have a central bank in the last 20 years, it would sound like our list of enemies, right? It'd be like Iraq, Syria, Venezuela. Like you list the countries that don't have central banks, and over time they have, regime change to spread democracy. Now they all have central banks, right? And so they're not going anywhere. They're here. They're sitting across the table from you, and they're experts in the game, and we're just stumbling around in the dark unless we learn the rules of their game. So the Fed, quote, prints money. Jerome Powell prints money. Jerome Powell creates inflation. Now this is also debated among economists, but we in the IBC world believe that inflation is the creation of money. It's the expansion of the money supply. And we point out that prices go up and people call that inflation, but in reality, that is a side effect. That's like the downstream effect of the creation of money, which is the actual cause of inflation. That would be the 100% money view. That would be Irving Fisher. The idea that by using fractional reserve and creating loans, you're creating money out of thin air. We can do a whole another episode on 100% money and the topic on that topic specifically. But who is actually creating this demand? It's not the Fed. The Fed is the lender of last resort. The Fed is the backstop. When we get angry at the Fed for creating money, contributing to inflation, price inflation by the expansion of the money supply, is that the Fed? No, it's Congress. It's your senator. It's your congressman. because the demand comes from Congress when they pass a budget and they say, here's what we need, and they don't slash spending. We need this much to pay, Medicaid and Social Security and all these unfunded liabilities. We need this much to fund the military, the NDA. We're going to give everyone in the military a raise just because cost of living is going up, whatever. They pass the budget and they say to the Treasury, which is a government entity, they say, here's how much money we need this year. And then we say we need $100 this year. The Treasury says, okay, we're going to sell Treasury bills, which is a form of money. It's not US dollars. It's not Federal Reserve notes. It's not dollar bills like we think of, but it's as good as money. It is money within our system. It's actually kind of the gold standard, so to speak, kind of a pun intended there, of fiat money is a US Treasury bill. It's what the whole world purchases as a stable store of value, which we would find that ironic, but that the Treasury bills are the real money. Like the dollars in circulation are a sliver of what the actual US dollar money supply is denominated in treasuries. So let's say that the Treasury goes to the market. The market consists of investors like you and me could go to itreasury.com, I think, and buy T-bills as an investment. Countries do that. We go to the whole world and we say, who wants to buy these bonds from us, these T-bills. Here's what we're paying an interest rate on the 1 year. Here's what we're paying an interest on the 5 year. Here's what we're paying interest rate on the 10 year. Right. And people buy those. And let's say the world buys $60 worth of the 100 that we're offering. Well, the Congress still needs the money. They still need the other 40. They say, hey, where's the other 40? And that's when the Fed comes in and says, okay, you want to fund this, you want to fund transgender surgeries for oppressed minorities in Wisconsin. So you're going to fund that. We'll backstop that. We'll provide the remaining 40. And that creates money. Now, that's a very simplistic fifth grade overview of a very complicated process. But that when we pull off the hood and see who's actually under the mask there, it's not Jerome Powell printing money. They're printing the Federal Reserve notes. More accurately, they're buying the T-bills. They have a big stack of T-bills on their balance sheet, but they're not the bad guys in the sense that, that they're causing this inflation. Like their function inherently inflates by increasing the money supply, by being the lender of last resort, by buying the last 40. What we want them to say, no, you're not getting the last 40. Go out and sell your goods, sell your stuff on the open market, but that you get what you get, right? So it's bad economics. You wouldn't let your kid do that, right? You want to buy this, you want to buy this bike, but you don't have money. You need to earn more. If you can't earn the money, then you got to wait and you got to save up, right? That's basic budgeting, right? That's simple. But if you're the parent that always steps in and it's like, oh, you want the $100 bike and you raise 60 on your paper route and here's the other 40, no questions asked. Well, what are they going to do? They're just going to, next time they're gonna be like, okay, now I want a $200 bike and now I want to get this video game and that's $500 and I can still only make $60, but now you're going to give me the rest without, you have a blank check. And so, yeah, of course they're going to keep asking for more and more. Your child's going to do that. The children in Congress are certainly doing that to the tune of trillions of dollars. And so it's not going to stop. And so that anger, I don't think is directed accurately at the Fed as the bad guy for the expansion of the money supply. They're performing their function. Should that not be their function? Yes. But the demand cycle comes from Congress. And so that's who we should be castigating here. Another thing, those two entities, the Fed and the Treasury, even though they're both the state in this view we're talking about, the charterless view, they're not always on the same page. And the perfect case in point was the last 4 years. If we look at the last 4 years, Jerome Powell has been a hero as far as what we want to see, i.e. the Fed reducing its balance sheet, the Fed trying to inject some kind of responsibility into this. I think Jerome Powell did a 180, and we go back to our talk with Joe Withrow. He has a really good theory on this. He's protecting U.S. banking interests against the globalists. Who are the globalists? It's the U.S. Treasury under Biden. It's the Biden administration. They're globalists. They're not Americans. Janet Yellen was at odds with Jerome Powell, and Powell's trying to say, no, we need to reduce this. We're going to draw down reserves. We're going to lower our balance sheet, which means banks need to bring their reserves back into the Federal Reserve, which is going to reduce the amount of money in the economy. And Janet Yellen said, oh, no, you don't. And so over the last 4 years under Biden, they typically, when they sell their stuff on the open market and they say, hey, we need $100, who's buying? typically they have a spread across the yield curve, which is another concept we'll talk about. That's the price. The yield curve is a snapshot in time price of what is the interest rate on different maturity bonds. So on today, March 26, 2025, what is the 1 year, the 3 year, 5 year, 10 year, whatever? That's the yield curve. 75% of the paper that she sold was at 1 year. So they're offering these tempting rates to people to try to sell more. And it's kind of like, I don't know, I'm trying to go with the kid analogy, getting a bike, but basically, like, rather than being responsible and trying to say, hey, I'm selling my candy bars, I bought them for $1 and I'm trying to sell them for $2 to make a profit. They're just like, hey, who wants them? 10 cents a piece, or, a dollar 10 a piece. I'll only make 10-cent profit, whatever. Or we'll just have them at cost, or have them at less than cost, whatever. I just want these candy bars out. I don't care how much profit I make. I'm not concerned about the economics of this. I'm just concerned about getting it out there. So they reduced, it was like 75% of the T-bills, I believe, during her tenure when she was at odds with Jerome Powell, were these 1 year trying to tempt people, because people are uncertain about the future of the US. They're uncertain about the power, backed by the full faith and trust of the federal government. Like that's kind of eroding right now. And so she reduced these to 1 year bonds to the tune of, I think, 75% of what she issued. That flies in the face of what you're trying to do if you're trying to dial it back in. And I think that the evidence is there that Jerome Powell was trying to dial it back in. The Fed was trying to, they did in fact reduce their balance sheet, which was inherently going to kind of cut off the money spigot. And so, yes, we can look at that period and say how much the supply increased under the Biden administration. We could say, yeah, the Fed printed all this money, but in reality, the Treasury was the one doing the dirty dealing there, and the Treasury was to blame. Jenny Yellen's to blame. The Biden administration is to blame. Just fire sailing our U.S. productivity and just trying to get it all out to the cheapest bidder. And so, all that to say, I think we're a little misplaced in who we are blaming for this. All right, and so this gets back to what we all know in the IBC world, where we all talk about fractional reserve banking. This is the actual, I would say that the individual actors who I think over the last 5 years, like I said, were the bad guys, were not the Fed, but as far as policies and systems, this fractional reserve system, on one hand, it's how you have the world reserve currency. It's how you find yourself in the position that the U.S. finds itself in right now. Everyone needs dollars, so we can leverage what we have and go build. We believe in leverage, right? I take my policy loan, I keep my capital growing, I leverage it to purchase a rental property, I pay off that policy loan. Now I have the rental property, and my principal never stop growing. It's IBC 101, right? We believe in leverage, but when you're leveraging things that you don't have, that's when you get in trouble. So a fractional reserve banking system is a banking system where a particular bank's liability, i.e. its deposit, is used as a means of payment. So deposits become means of payment when they're transferable by check or by note, where the note is payable to the bearer without reference to the depositor against whose deposit it was originally issued. In normal terms, I deposit my $100 at the bank. The maximum amount of deposits that can result from the initial creation of the monetary base equal to $100 corresponds to $1,000. Now, that gets there by kind of a series of lending. So I'm going to read from this book here. The concept of the money multiplier makes it possible to define the link between narrow money and broad money. Narrow money, remember we talked about the different types of money that add together to equal broad money. We've got narrow money is state money in our previous parlance, and broad money is the total money that's out there. What is the difference? Is bank money, right? So that's how we know we have our state money as the base. How much is created off of that equals our broad money. It's possible to find the link between narrow money and broad money. Orthodox economists assume that the process begins when, for instance, $100 of monetary base issued by the central bank is deposited into Bank A. Bank A is not required to create a reserve of $100, as happens in a full reserve system, i.e. they have to hold on to that $100, but can choose to establish a reserve equal to a fraction K of deposits. For example, equal to 10% per deposit. Then Bank A can lend out the remaining 90. So 90 of my dollars are going out to other people. The loan recipient, so let's just say it's one other person gets $90. They get loan 90, and that comes from my $100, but they only had to hold on to 10 of it. The loan recipient soon spends these $90, and we can assume the receiver of this amount deposits it to Bank B. Bank B is now in the same situation as Bank A. It sets aside 10% of those $90 as reserves and lends out the remaining $81. The process continues until the entire new monetary base will be used by banks to increase their reserves. As reserves correspond to 10% of bank deposits, the maximum amount of deposits that can result from the initial creation of the monetary base equal to $100 corresponds to $1,000. So it's not quite what we hear often, which is that you deposit $100 and they go out and loan $900. They have to hold on to 10% of that. They can loan out the rest. So $90 out of my 100 is loaned out to other people. Someone else has a claim on that money as well. Now we have multiple claimants on that same initial deposit. So the orthodox economists believe that central banks can control the quantity of bank deposits by managing the monetary base. Banks create money when they receive a deposit because they give depositors an asset that, though legally only a claim to legal tender money, serves within very wide limits the same purposes that this money itself would serve. This implies that the depositors lend nothing in the sense of giving up the use of their money. They continue to spend, paying by check instead of by coin. And while they go spending as if they had kept their coins, the borrowers likewise spend the same money at the same time. And so if you ask someone, back to what I said at the beginning, if you ask someone, hey, did you know, like you do that works at the Fed, did you know the fractional reserve banking? Like, yeah, of course. How else would you have, like, do you just want a fixed amount of money? And they'd say, yeah, no, yeah, of course you can have. Why wouldn't you want 9 people to have, or 10 people to have $100 instead of just one? How can you grow? So if those other 9 people can then go and do things and invest that money and grow it, et cetera, grow the economy and productive output, et cetera, why would you not want that? What's the problem with this? And the idea gets back to, and this is when you really start to get into modern monetary theory. The idea is that, like, it doesn't matter what the money multiplier is. It doesn't matter what the creation of money is, because as long as the state can control the narrow money or the state money or the monetary base, whatever you call it, we'll call it the state money. If they can control that and they can control the money multiplier, 1 over K, aka the fractional reserve ratio, the reserve requirement, different terms that we call it, if they can control those two things, how much monetary base is out there, how much state money is out there, and then how much banks can go create via the money multiplier. Well, what's wrong with that? Why does it matter? Because you're just kind of taking an arbitrary thing. We, the state, determine that taxes are due in dollars, and we manage the creation of dollars. So what does it matter? You could argue, I guess, in a perfect world, that if it wouldn't matter if income and prices moved up together. Who cares if the tide's rising if you just need to stay afloat and if all boats are rising? But the problem is, as we know, it gets out of control. It has spiraled way out of control. The tide is rising, and a lot of people have patchy boats and they're sinking because the cost of goods is going up. Wages are not going up accordingly. And so there is a nearly, I'm not gonna say perfect correlation, but the amount of money in the system, the amount of money that's been created over the last couple of decades tracks very closely to the price of assets on a relative scale. So asset price inflation is a very real thing we need to understand. And so what happens when they start pulling money out of the system? What happens if we start going the other way? What happens if a ton of money goes into a crypto and that crypto explodes and we wipe off $1 trillion of market cap and it just disappears? Well, those are dollars out of the economy. In a credit bubble like this, where everything is leveraged, a credit collapse, a debt deflation is inherently deflationary. And so if the market tracks almost perfectly with the creation of money, and we have this idea the market's going to go up and right forever, and that I'm not going to say with certainty that is because the money supply has gone up and right over the same time period to the same degree. I believe that causation is correlation is causation in this case, but we can guess that it is, but I'm not going to say it is. Well, if it tracks up with the creation of money, then might it make sense why they're so desperate to avoid deflation? Like, we kind of think it's crazy that they have a target inflation rate of 2%. And of course they're way over that, but why even have a target? Why even want inflation? Well, because if you start deflating you're going to pull the air out of it could spiral quickly. One, this debt deflation spiral, and that's the fever break that we talk about. But two, if asset prices track upward with the creation of money, do you want to be the Fed chairman? Do you want to be the Treasury secretary? Do you want to be the president under whom we have this reversion back to health? It's a good thing when these things come down, but how many millions of people are going to retire this year? Like the largest wave of boomers retiring, or of anyone retiring, is like this current segment of boomers that are retiring. Their entire strategy is built on market performance and the value of their house, right? If asset price inflation stops and it goes down because money is destroyed, i.e., crypto collapsing, a startup company overvalued collapses, like all these things where the money can get sucked out of the system as easily as being pumped in. Well, that could get really bad really quick for a lot of people, and no politician wants to be the one at the helm when that happens. So a few pros and cons from the takes in this book. And I like this book, the Encyclopedia of Central Banking, because it's from the perspective of central bankers. It's from economists who believe this. But again, that's all of them. Like almost every economist believes this, and these are the rules they're playing by. It's not like as critical of central banking as I might lean, but it's written with enough ability to look at both sides. And when it presents a topic, whether that's 100% money, whether that's state money versus bank money, whether that's metalism versus chartalism, it gives you the pros and cons. And so the people that are in support of this idea and the creation of money would say that central banks control the quantity of bank deposits by managing the monetary base, and the money multiplier does not change the nature of banks. Banks are kind of subject in their view to, like I said, the state determines what the base is, and the state determines how much they can make. And so there's like, all right, well, if you say I can, turn 100 into 1,000, well, we're going to do that. We collectively are all the banks in the process of bank A, bank B in that example. Banks don't create the money. They're just intermediaries that lend what they collect within their limits, what's prescribed to them. If the money multiplier is known and the central banks create the monetary base, the terms are already set for the determination of broad money. Banks simply facilitate this. On the critical side, they would say that banks create money when they receive a deposit because they give the depositor an asset. Like I said earlier, that though legally only a claim, serves within wide limits the same purpose as the money itself would serve. So you have a bunch of people going around spending the same money. They would say it's much more realistic to say that banks create credit, that is, they create deposits in their act of lending, than it is to say that they lend the deposits they have entrusted to them. I fall in that camp. I think that this expansion of the money supply by having a fractional reserve I could steel man the other side of the argument, where you could say that that's how we get to the status today. And guys, let's remember, we have the world reserve currency, and we have it because of this system. So we have profited greatly from it. Yes, a lot of us, our incomes have not risen with the cost of assets, but think about, the line around the world for US dollars is as long as the global population. We are in, like, it trickles down, and not trickle down economics, not that stuff. Just, I'm saying that, like, we are the beneficiaries of the Cantillon effect, where the money goes to us first as a nation. Like, we get the fruits of this labor, this fake labor, but we get the fruits of it. It's how we can all afford a new car every couple of years if we want. It's how, you can get a house worth, 10 times your salary and pay for 30 years on it. Like that, the mechanics of this system is how we have a lot of what we have today, that we've replaced this money, this system, this creation of money has replaced our need to create value. I would rather be in a more moral, just world where you have to create value. Money follows the value. And as you provide value, the money comes to you and you can acquire what you want. But we've kind of got a cheat code here where we don't really need to create much value and still have this cush lifestyle. Anthony Papagliano says, America is the major league of economics. Everyone wants to play here. And so we are right to criticize this, but I really want us being in the IBC community, IBC practitioners, and people practicing IBC in their own families. Like, I just want people to understand the rules of this game and see a little bit. Like, you should be able to explain, if you're going to take a strong position, you should be able to fluently explain the other side. And that's what I'm trying to do in my learning. And it helps me to vocalize it because I feel like I've butchered most of what I had in my head, and I hope it's makes some kind of sense. But I want us to know the enemy. I want us to know what we're dealing with. I want us to recognize that the rules of the game are not going to change materially, I don't believe, in our lifetime. And therefore we can prepare and we can do the things we need to do to bolster our protect our castle against a lot of catastrophic things that could happen economically. But in the event things continue down this path, we should also be optimizing in the fiat world. And so I'll end it there. I want to do more of these, perhaps selfishly, because I just like talking about this stuff. And I know most people don't like talking about it. No, people don't want to have a discussion about the history of money late at night. And so I would love to do more of these. I would love feedback if this was actually helpful and if it made any sense. Maybe this is just not the right kind of medium for this, but I want to talk through more concepts because I just think it's important to always expand your knowledge and to always be learning about economics. Because if we understand economics, if we understand financial physics and the rules of the game, we can do the other things that are more important to us than economics. But this is a great facilitator for what we want to do. And so I'll end with know your enemy. Give me feedback on this. If shoot me a text or an email, goods, bads. If it was terrible, I want to hear that. If it bored you to tears, too long, whatever. Or if you want more discussion like this, it's a lot better with Brian because I feel like I have been talking for over an hour now, and it's just kind of weird. Like, what do I do with my hands? Because I don't have Brian here to go back and forth with. But yeah, maybe Brian and I could talk more through this. Maybe he doesn't want to do that. I don't know. We'll see. But yeah, let me know what you think. Hope you guys have a good week, and we'll talk to you next time. Cheers.